look, I'm going to show you something that might make you a little angry at yourself. If you're 30 years old right now and you start investing just $6,000 per year into a low-cost index fund, that's $500 a month, and you average a 7% return after inflation, by the time you're 65, you'll have about $1.3 million. Now, here's the part that stings. If you wait just 5 more years and start at 35 with the exact same contributions, same $500 per month, same 7% return, you end up with around $800,000. You just lost $500,000 by waiting 5 years. Wait until you're 40 to start. You're looking at about $470,000 by 65. Every single year you delay costs you exponentially more because of how compound interest works. And I wish someone had grabbed me by the shoulders at 25 and shown me this math, because I'd be 10 years ahead right now. But here's the thing, and this is actually the good news. It is still worth starting today. Whether you're 30, 35, 40, or 50, the best time to plant a tree was 20 years ago, and the second best time is right now. So if you've been paralyzed by fear or overwhelmed by choices, or convinced you need to wait until you understand everything perfectly, this video is for you. My name is John, and I spend way too much time thinking about how starting with just $50 per month can build real wealth over 20 to 30 years through consistent index fund investing. If you are someone who you convince yourself you need $5,000 or $10,000 saved up before you can really start investing, so you've been waiting for years. Every article you read mentions maxing out retirement accounts at $23,000 per year, which feels laughable when you're living paycheck to paycheck. Your coworker casually mentioned she's been investing $100 every 2 weeks since age 23, and now at 35 she has over $80,000. Meanwhile, you're 32 with nothing invested. You finally realize that waiting for the perfect amount has cost you a decade of compound growth, and starting small today beats starting big someday. Make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Let me destroy some myths right now that are keeping you broke. Myth number 1, you need a lot of money to start investing. Completely false. Most brokerages, Fidelity, Vanguard, Schwab, let you open a Roth IRA or regular brokerage account with $0. You can buy fractional shares of index funds with as little as $1. I'm serious. If you have $50 per month to invest, you can start today. The actual barrier is not money. It's the story you're telling yourself about needing more money. Myth number 2, you need to understand the stock market perfectly before you invest. Also false, and this one keeps smart people poor longer than anything else. You're waiting to read the right book, take the right course, understand economic indicators, learn technical analysis. Meanwhile, your money sits in a savings account earning 0.5% while inflation runs at 3%. So you're actually losing 2.5% per year in purchasing power. Here's what you actually need to know to start investing successfully. Buy a low-cost index fund that tracks the total U.S. stock market or the S&P 500. Contribute money automatically every month, and do not sell when the market drops. That's it. You just learned everything you need to know in one sentence. Myth number 3, you need to pick the right stocks to make money. This is the myth that makes brokerage firms and financial TV networks rich, while keeping you anxious and poor. Listen, 90% of professional fund managers with entire research teams and Bloomberg terminals cannot beat a simple S&P 500 index fund over 10-year periods. 90%. You know what your chances are consistently picking winning stocks as a beginner working a full-time job? Basically 0. And even if you pick one winner, you need to overcome the losers, the taxes on short-term gains, the emotional roller coaster of watching individual stocks, and the time you waste researching instead of just working and earning more money to invest. Myth number 4, you need to time the market perfectly, buying low and selling high. I know this feels intuitive. Buy when stocks are cheap, sell when they're expensive, right? Except nobody, and I mean nobody, can consistently predict market tops and bottoms. There's academic research on this going back decades. Even if you were the unluckiest investor in history and invested $10,000 at the absolute peak right before every major crash, the 1987 crash, the 2000 dot-com bubble, the 2008 financial crisis, the 2020 COVID crash, and you just held through all of them without selling, you still have way more money today than if you kept it in cash waiting for the perfect time. Time in the market beats time in the market every single time over long periods. Myth number 5, investing is basically gambling. Okay, look, I get why people think this, especially if you grew up watching family members lose money in the stock market, or if your only exposure to investing is headlines about meme stocks and crypto crashes. But here's the difference. Gambling is a zero-sum game with a house edge designed to take your money over time. Investing in index funds means you own tiny pieces of hundreds or thousands of profitable companies that generate real earnings and grow over time. The S&P 500 has returned an average of about 10% per year for the last 50 years, closer to 7% after inflation. That's not luck. That's companies making products, earning profits, and sharing those profits with shareholders. You know what actually is gambling? Buying individual stocks you read about on Reddit, chasing whatever crypto coin is trending on Twitter, trying to day trade while working your regular job. That stuff is way more in common with a casino than investing in a diversified index fund does. But let's talk about the real reason you haven't started investing yet. And it's not because you don't understand compound interest or because you haven't found the right brokerage. It's because you're scared. And that's completely normal and rational. So I'm not going to tell you your fear is stupid. I'm going to tell you why your fear is lying to you. The biggest psychological barrier is loss aversion. This is a proven cognitive bias where losing $100 hurts about twice as much as gaining $100 feels good. So when you think about putting your money in the stock market, your brain immediately jumps to the possibility of loss. What if the market crashes right after I invest? What if I lose half my money? What if I need that money and it's gone? These fears feel huge and real, and they completely overwhelm the abstract possibility of gains 20 or 30 years from now. Here's what your brain is not telling you. You're already losing money by not investing. Inflation is running at about 3% per year right now. Your savings account is probably paying you less than 1%. So every year, your cash is losing about 2% of its purchasing power. You are experiencing the loss you're afraid of right now, today, by keeping everything in cash. It's just slow and invisible instead of sudden and obvious. And here's the thing about market crashes that your fear won't let you see clearly. If you're investing for retirement 20 or 30 years from now, a market crash is actually the best thing that can happen to you early in your investing journey because you get to buy more shares at cheaper prices with your regular contributions. The people who got destroyed in 2008 were the ones who panicked and sold at the bottom. The people who kept contributing through the crash and recovery made an absolute fortune. The second major psychological barrier is analysis paralysis. You've got Roth IRA versus traditional IRA versus 401k versus taxable brokerage accounts. You've got large cap versus small cap versus international versus bonds. You've got Vanguard versus Fidelity versus Schwab. You got VOO versus VTI versus VTSAX. And your brain just freezes because what if you choose wrong? What if there's a better option you didn't consider? Here is a truth that will set you free. The difference between the optimal choice and the pretty good choice is so small that it barely matters, especially when you're just starting out. You know what matters? Starting. A Roth IRA with VTI at Vanguard versus a Roth IRA with VOO at Fidelity is a difference of maybe 0.05% per year in returns. You know what costs you way more than that? Spending 6 months researching and comparing and not investing at all during that time. Just pick one and start. You can always change later. The third barrier is a comparison trap. And this one is brutal because social media makes it so much worse. Your friend who started investing at 22 just posted about hitting 100,000 in their retirement account at 30. Your cousin is bragging about some crypto that went up 500%. Some influencer is showing screenshots of their stock portfolio up 40% this year. And you're sitting there at 35 with basically nothing invested, feeling like you're so far behind that there's no point even starting. Listen to me. Comparing your chapter 1 to someone else's chapter 10 is a recipe for permanent inaction. Yes, starting at 22 would have been better than starting at 35. We already established that with the compound interest math, but you cannot go back in time. You can only control what you do starting today. And the person who starts investing at 35 is going to be in a radically better position at 65 than the person who spent their 30s and 40s feeling bad about not starting at 22. Also, here's what nobody tells you about those comparison traps. Most people lie about their investment returns, either deliberately or because they're only showing you their winners and not their losers. That crypto that went up 500%, they're not posting about the 3 other cryptos that went to zero. That stock portfolio up 40% this year, they're not mentioning that it's down 30% over the last 3 years. Your friend with 100,000 at 30, you don't know if they inherited money, if their parents matched their contributions, if they're in massive student loan debt, or if they're about to lose it all trying to day trade. Stop comparing. The fourth psychological barrier is perfectionism masquerading as responsibility. You tell yourself, I need to fully understand how the stock market works before I invest my hard-earned money. I need to read The Intelligent Investor and A Random Walk Down Wall Street. I need to understand PE ratios and dividend yields and market cap and sector allocation. You convince yourself that this is you being smart and careful with your money, but really, it's you being afraid and using learning as procrastination. I'm not saying education is bad. I'm saying that you already know enough to start investing investing in index funds today, and you're using education as an excuse to delay. You do not need a finance degree to buy VTI and hold it for 30 years. You do not need to understand quantitative easing or the yield curve. Those things might be interesting to learn eventually, but they are not prerequisites for building wealth through boring, simple index fund investing. The fifth barrier is market timing temptation, which is really just another form of perfectionism. You're waiting for the market to drop before you invest because you don't want to buy at the top. This feels so logical. Why would I invest today when the market might be 20% cheaper in 6 months? But here's what actually happens. You wait for the drop, the market goes up another 10%. Now you really don't want to buy because it's even more expensive. Then it drops 5%, but you're waiting for it to drop 20% like last time. Then it goes back up 15%. And you've now been waiting a year and a half. And the market is 20% higher than when you first decided to wait, and you still haven't invested anything. Meanwhile, your coworker who just started contributing every 2 weeks without thinking about timing has made money during that entire period. You cannot time the market. Even professionals cannot do it. So just start contributing regularly and stop watching the ticker. Okay, now let's talk about why compound interest is the closest thing to magic that exists in personal finance, and why understanding this math will change how you think about every dollar you earn. Compound interest means you earn returns not just on your original investment, but on all the previous returns too. So if you invest $10,000 and it grows 10% in year 1, you have $11,000. In year 2, if it grows another 10%, you're not just earning 10% on your original $10,000. You're earning 10% on $11,000, which gives you $12,100. The next year, 10% on $12,100. This sounds small at first, but it creates exponential growth over decades. Here's a concrete example that shows you exactly how starting age affects your final outcome. Let's say you invest $500 per month, which is $6,000 per year, and we'll assume a 7% average annual return after inflation, which is conservative based on historical S&P 500 performance. If you start at age 25 and invest until 65, that's 40 years of contributions. You'll contribute a total of $240,000 of your own money. But because of compound interest, you'll end up with approximately $1.37 million at retirement. Your money earned over $1 million for you while you slept. Now, same scenario, but you start at 30. That's 35 years instead of 40. You contribute $210,000 total. You end up with about $900,000. You lost almost $500,000 by waiting 5 years, even though you only reduce your total contributions by $30,000. Start at 35, 30 years of investing. You contribute $180,000. You end up with about $600,000. Start at 40, 25 years. Contribute $150,000. End up with about $400,000. Start at 45, 20 years. Contribute $120,000. End up with about $250,000. Do you see what's happening here? The earlier money has way more time to compound, so it grows exponentially more than the later money. The $6,000 you invest at age 25 has 40 years to compound and is worth way more at retirement than the $6,000 you invest at age 55, which only has 10 years to compound. This is why starting early is so powerful, and it's also why every year you delay is so expensive. But here's the part your brain needs to really absorb. Even starting at 45 and ending up with $250,000 is infinitely better than not investing at all and ending up with zero. You cannot undo the years you didn't invest. You can only control starting now. Let me show you another angle on this. Dollar cost averaging and why it makes market volatility work for you instead of against you. Dollar cost averaging just means investing the same amount of money at regular intervals, regardless of whether the market is up or down. So you invest $500 on the first of every month, no matter what. When the market is high and shares are expensive, your $500 buys fewer shares. When the market drops and shares are cheap, your $500 buys more shares. Over time, this averages out your purchase price and means you're automatically buying more when things are on sale and less when they're expensive. You're doing the exact opposite of what emotional investors do, which is buying more when prices are high because they feel confident and selling when prices are low because they're scared. Here's real data. If you invested $10,000 per year in an S&P 500 index fund starting in 2000, literally the worst timing possible right before the dot-com crash, and you kept investing through the 2008 financial crisis and the 2020 COVID crash, you have over $700,000 today from about $250,000 in contributions. And that includes investing right before two of the worst crashes in modern history. The math is clear. Long time horizon smooth out volatility. A 20 or 30 year investing period includes multiple crashes and recoveries recoveries. The recoveries always outpace the crashes over long periods. This is why investing is safe if you don't panic sell, and why market timing doesn't matter nearly as much as time in the market. One more critical piece of math: expense ratios and how they silently destroy your wealth. An expense ratio is the annual fee a fund charges to manage your money, expressed as percentage. An actively managed mutual fund might charge 0.8% per year. A Vanguard index fund like VTI charges 0.03% per year. That difference sounds tiny, right? 0.77%. But let's run the math. If you invest $500 per month for 30 years at 7% average returns, and you're paying a 0.8% expense ratio, you end up with about $540,000. If you're paying a 0.03% expense ratio on an index fund, you end up with about $600,000. That tiny difference in fees costs you $60,000 over 30 years. This is why I keep saying low-cost index funds. Every percentage point in fees is a percentage point that doesn't get to compound for you. Choose funds with expense ratios under 0.1% if possible. All right, enough theory. Let me give you the exact steps to start investing today, with specific platform names, fund tickers, and dollar amounts. No more excuses, no more confusion, just action. Step 1. Choose between a Roth IRA or increasing your 401k contribution. Here's how to decide. If your employer offers a 401k match, meaning they contribute money when you contribute, max out the match first. That's free money, and it's an instant 100% return. If they match 50% on the first 6% you contribute at least 6%. Then, after you're getting a full match, open a Roth IRA. A Roth IRA is a retirement account where you contribute after-tax money, and then all the growth and withdrawals in retirement are completely tax-free. You can contribute up to $7,000 per year in 2026 if you're under 50, $8,500 if you're 50 or older. A traditional IRA gives you a tax deduction now, but you pay taxes on withdrawals in retirement. For most people starting in their 20s, 30s, or early 40s, Roth is better because you're probably in a lower tax bracket now than you will be in retirement, and tax-free growth for 30 or 40 years is incredibly powerful. Step 2. Open your account at Fidelity, Vanguard, or Schwab. These are the 3 big low-cost brokerages, and honestly, they're all good. Vanguard invented the index fund and has rock-bottom fees. Fidelity has a slightly better mobile app and customer service. Schwab is somewhere in the middle. Just pick one. I use Fidelity because I like their app, but this is not a critical decision. You can open an account online in about 10 minutes. You'll need your social security number, bank account information for transfers, and basic employment info. Step 3. Choose your index fund. I'm going to make this incredibly simple. Buy VTI if you're at Vanguard, or FZROX if you're at Fidelity, or SWTSX if you're at Schwab. These are all total U.S. stock market index funds, meaning you own tiny pieces of basically every publicly traded company in America. VTI has an expense ratio of 0.03%. FZROX and SWTSX are 0% expense ratios. You are instantly diversified across thousands of companies. If you want something even simpler, buy a target date retirement fund. These automatically adjust from stocks to bonds as you get closer to retirement. At Vanguard, it's something like VTTSX, Target Retirement 2060. At Fidelity, it's FDKLX, Freedom 2060. At Schwab, it's SWYNX, Target 2060. Pick the year closest to when you'll turn 65. The expense ratios are slightly higher, around 0.15%, but still very low, and it's completely hands-off. Do not buy individual stocks. Do not buy actively managed funds with 1% expense ratios. Do not buy whatever your friend is hyping on social media. Just buy the boring index fund and move on with your life. Step 4. Set up automatic contributions. This is the most important step because it removes willpower and decision-making from the equation. Log into your brokerage account, find the automatic investment option, and set up a recurring transfer from your checking account to your IRA on the same day, every month, or every 2 weeks when you get paid. Start with whatever you can afford. $50 a month, $100 a month, $200 every 2 weeks. It doesn't matter. What matters is that it happens automatically without you thinking about it. The psychological benefit here is huge. You're not watching the market and deciding whether today is a good day to invest. You're not talking yourself out of it because the news looks scary. The money just moves automatically. You buy shares automatically, and you never have to make the decision again. Step 5. Understand the tax advantages and contribution limits. For 2026, you can contribute up to $7,000 per year to a Roth IRA if you're under 50. If you're 50 or older, it's $8,500. For a 401k, the limit is $23,000, if you're under 50, $30,500 if you're 50 or older. These limits go up slightly most years to adjust for inflation. Roth contributions. You pay taxes on the money now at your current tax rate. Then all growth is tax-free forever, and withdrawals in retirement are tax-free. Traditional 401k or IRA contributions. You get a tax deduction now, reducing your taxable income this year. But you pay taxes on withdrawals in retirement. For most people, maxing a Roth IRA first is a move, then contributing to your 401k up to the employer match, then going back and contributing more to the 401k if you still have money left. Step 6. Ignore your account. Seriously, set up the automatic contributions. Then do not check your balance every day. Do not watch the market news. Do not panic when you see your account down 10% in a correction. The entire strategy depends on you not selling when the market drops. Checking your account constantly makes you way more likely to panic and do something stupid. Check your account once a quarter to make sure contributions are happening correctly. Rebalance once a year if you're managing your own allocation, or never if you're in a target date fund, because it rebalances automatically. Otherwise, ignore it and let compound interest do its thing for 20 or 30 years. Step 7. Increase your contributions when you get raises. This is how you go from investing $50 a month to $500 a month over the course of your career. When you get a raise or a bonus, increase your automatic contribution by half of the raise amount. You still get to enjoy some of the extra money, but you're also accelerating your path to financial independence. If you get a $3,000 raise, increase your monthly contribution by $125. You'll barely notice it because you never got used to having that money in the first place. That's it. Those are the steps. You now know exactly what to do. Open an account at Fidelity, Vanguard, or Schwab. Choose VTI or the equivalent total market fund. Set up automatic monthly contributions. Do not sell when the market drops. Increase contributions when you get raises. Ignore the account for decades. You will be rich when you retire. If you wish you had started investing earlier, but you're realizing it's still worth starting today, hit that like button right now. Seriously, if this video just shifted your mindset from I'm too late to I'm starting this week, let me know with a like. Subscribe for simple investing strategies that actually work and that don't require you to become a finance expert or stare at stock charts all day. I make videos breaking down personal finance in plain English for people who just want to build wealth without it becoming a second job. And comment your age and whether you've started investing yet. No judgment. I'm serious. I respond to every comment. And honestly, the community in the comment section is super helpful. People share what platforms they use, what funds they picked, what mental barriers they had to overcome. It's worth reading through. My name is John. Stop waiting for the perfect time to invest and start letting compound interest work for you.